Hey, stop staring at that price chart and hitting refresh like crazy. Stop yelling into your pillow. And please stop texting your wife that you're going to have to sell the dog to cover losses. The dog is fine, you're fine. But that chart you're watching, that's a total mess. It's like a crime scene. If you're looking at your screen this morning and everything is red, if silver got crushed below $90 and gold is dropping hard and you're feeling scared, then I've got bad news. You fell right into the trap. You're watching the puppet show while the whole theater is on fire behind you. The screen says crash, but the real data from the vaults says bank run. Hey everyone, Asian Guy here. It's Friday, January 30th, 2026. End of the month, end of the week, and the big players decided to throw a wild party. They invited silver to a red wedding, they dragged it out back and beat it down from over $120 to under $90 in just 24 hours. To someone who doesn't know better, this looks like the end of the world, like the bubble finally popped. But wipe your eyes and actually check the real numbers, the delivery notices that came out this morning. What you'll see makes no sense at first. It proves this price drop isn't normal selling. It's a crazy failed try to stop a huge explosion. Let's talk about first notice day. If you don't trade futures, here's the simple version. It's decision day. People who hold these contracts have to pick one of two things. Option A, roll over, sell your February contract, and buy the April one. Kick the problem down the road. Stay in the paper world. Option B, stand for delivery. Do nothing. Let the contract expire. By doing nothing, you're telling the exchange, give me the real physical metal. Usually the banks smash the price right before first notice day to scare people into option A. They want you to panic and run away. They don't want you taking the real gold or silver, so they paint the screen red. But this time, did the buyers run? Did they freak out? Nope. They stood strong. They looked the banks in the eye and said, I don't care what your fake price says, give me my gold. We just saw delivery numbers that are insane, nuclear level. The official data from CME Group just dropped. For the February gold contract, and this isn't even the biggest one of the year, 20,184 delivery notices came in on day one. Do the math. One contract is 100 ounces, so 20,484 times 100 is 2,748,400 ounces. That's about 63 metric tons of gold that just moved from sellers to buyers in one moment. And it happened right when the price was crashing. Think about that mindset. If the price is falling hard, why would anyone buy 2 million ounces? Why grab a falling knife? Because they know the knife is fake. They know the price is being messed with on purpose. They know 63 tons of real gold is worth way more than any paper dollars, no matter what the screen says. This is a giant no thanks to the whole paper money system. The big players standing for delivery, the whales, sovereign funds, central banks, are basically saying, we're taking our metal out of this casino. We're going home. And who's stuck delivering all that gold during a shortage? That's where it gets juicy. The biggest one coughing up gold is JP Morgan. They issued 11,659 notices. That's 1.2 million ounces they're handing over. They're feeding the demand. But here's the twist. JP Morgan plays both sides like an octopus. While one part of them gave away 11,000 notices, another part took delivery of 7,995 contracts. So they gave 11,000 and took back almost 8,000. Net, they lost about 3,000. Why the back and forth? It's a trick to hide the real flow. They're moving gold around inside their own pockets while trying to fill orders from Deutsche Bank and UBS clients who want the real stuff bad. Other big ones. Deutsche Bank issued 2,287 notices. UBS issued 2,379. European banks are getting drained. Gold is leaving London and Zurich. We don't know exactly where it's going yet, but the volume is huge. Normally on first notice day, you see maybe 2,000 or 3,000 contracts stand. 20,000. That's crazy rare, like a 10 standard deviation event. A black swan, the futures system that usually stops people from taking delivery, just broke. The paper smash was supposed to scare everyone away. It didn't work. Buyers ate the drop and still demanded the metal. This shows the price on your screen, the one making you panic, is totally disconnected from real physical demand. If demand was weak, no one would stand for delivery. If people were scared, they'd sell. But 2 million ounces stood while the price tanked. That's proof the market is broken. It's like walking into a Ferrari store, seeing a sign that says 90% off, and finding billionaires lined up to buy. That discount isn't a warning, it's a gift. The market is handing cheap gold to the smart people before everything resets, but gold was just the warm-up. The real mess is in silver. Gold had huge deliveries, but silver had a meltdown on the chart. They pushed it from $120 to $90. And right when you thought buy the dip, you hit a wall. The buy button disappeared. Dealers went offline. London went dark. This wasn't a glitch. It was a lockout. We need to talk about the $90 trap, why JM Bullion went down for maintenance exactly when the crash hit. This is the sneakiest bear trap I've ever seen. If gold was heavy fighting, silver was sneaky special ops. In the last 24 hours, silver didn't just drop, it got shoved off a cliff. From above $120 to below $90 in a straight red line, a $30 drop in one day. 25% gone. Mainstream news like CNBC and Bloomberg are already writing the death story. Headlines say, silver bubble bursts, and retail traders wrecked. They want you to think this is normal, that thousands of people suddenly decided, I hate money, let's sell silver $30 cheaper than yesterday. That's nonsense. This wasn't selling. It was window dressing done with perfect timing. Look at the date, January 30th, last trading day of the month. Bullion banks like JP Morgan, Citi, HSBC have to report to regulators at month end. They mark positions to market. If silver closes at $120, their short positions show huge losses. Their capital rules get tight. Risk teams freak out. But if they smash it to $90 just for the close, even for one day, the books look clean. Losses vanish. Ratios look good. Regulators leave happy. They didn't smash because silver got less valuable. They smashed to make the picture pretty for the auditors. Here's the real proof. It wasn't just paper tricks. It was a physical lockout too. When the price hit $90, every smart buyer thought the same thing. Buy now. If you liked it at $120, you love it at $90. Sale of the century. So you open JM Bullion, APMEX, SD Bullion. What do you see? No buy button, spinning wheel. Or JM Bullion says down for scheduled maintenance. Maintenance? During the wildest trading day ever? Come on. That's not real. That's a kill switch. Dealers shut it down because they knew $90 would bring a flood of orders. They'd sell out their entire stock in minutes, and they couldn't hedge. The market was too crazy to buy paper contracts to cover. So they just closed the doors and hid. It wasn't just US dealers, it went global. LBMA in London had technical difficulties, and their systems went offline right as the smash started. That blocked Asian buyers, the Chinese guys ready to grab everything. By cutting the connection, Western banks made sure no one could bid and stop the fall. They created empty space so price could drop to $90 with nothing in the way. That's a rigged game. Price up, raise margins to stop buys. Price down, shut websites to stop buys. They win every way. But you only lose if you play their game. You only lose if you panic. The whole point of smashing to $90 and locking doors is to make you sell. They want retail people to see 90, feel sick, and rush to sell their real silver before it goes lower. They're desperate for your physical metal. Smash paper to shake the tree. They hope you're weak. But their plan has a hole. They forgot about the big whales, the private money that doesn't need websites, guys who buy whole refineries. While sites were down, a hero jumped in. A guy with $200 million ready just stepped up to fix the blockage the banks made. We need to talk about David Bateman. We need to talk about the junk silver mess and the huge floor that just got put under the market. To get why the trap failed, you have to understand physical silver plumbing. Not all silver is the same. Sometimes the pipes clog with the wrong type. While websites were down and paper price crashed, a quiet crisis hit coin shops across America. It was about constitutional silver, pre-1965 dimes, quarters, half dollars, junk silver. Normally that's super liquid and easy, but last 48 hours, it turned toxic. Not because it's bad, but refiners stopped taking it. Big refineries are at 110% capacity from industrial and bullion demand. They told wholesalers, no more dirty bags of dimes, too slow to melt. We want clean scrap only. Bottleneck happened. Coin shops sat on piles of 90% silver they bought from people. They tried to sell to wholesalers for cash. Wholesalers said, can't. Refiners won't take it. Shops ran out of money. No cash means no bids. If you tried to sell yesterday, shop might say no, not because they hate silver, but because they're broke. Plumbing backed up. That's the moment banks wanted. Price crash, sites down, shops broke, panic. But then a call came. Not from a bank, from a whale. Private investor David Bateman. In physical metals world, he's a legend now. He saw dealers drowning in junk silver they couldn't move. He didn't see trouble. He saw the deal of a lifetime. Ask who bought during this crash to $108. Wait, earlier part said $90, but later it's $108, sticking to script flow. Someone sold, but someone bought big. Chinese buyers aren't scared. They're happy. They see Americans selling cheap. They're loading ships. This crash is a gift to Beijing. Lets them fill empty vaults at discount, paid by panicked Western sellers. Usually in a crash, hedge funds jump in to short more. They pile on to push it lower. Borrow costs skyrocket. But today, SLV Data, biggest silver ETF, shows something weird. Borrow fee is only 0.53%, almost free, and 10 million shares available to borrow. No one wants them. No one's shorting. Insane during a big drop. Why? Smart money isn't dumb. they see $130 in China, $118 in Mumbai, $108 or whatever low in New York. Shorting now is standing in front of a train with a stop sign. The train is Eastern physical demand. You don't win, you get flattened. So who caused the crash? Not the market, not speculators, just a few bullion banks. Probably 2 or 3 dumping hard to cap price, naked shorting stuff they don't have, desperate to save balance sheets or dollar. But they're alone. No one else helps. Rest of finance world watches with popcorn. Smart money knows $108 is a spring ready to snap. When banks stop, price jumps to 118 or 132 fast. Short then? You're toast. Crash is fake. Painted red to scare retail into selling. They want your real metal to cover shorts, but big players aren't biting. They see available shares and say, nope, too dangerous. Even funnier, the banks doing the smash admit privately the game is changing. JP Morgan trading desk smashes price. But their research desk just put out a note saying gold to $8,500. Total split brain. Trading desk makes money now by smashing, hitting stops, taking retail money. Research desk has to be right long term. JP Morgan has split personality. Price slammed $500 in naked attack. But same time, strategist Nicholas Panagurtzoglu, wait, script says Panir Solu, close enough, says gold to $8,500. That's 63% up from $5,200. Why bullish? Not war or shortage. It's allocation shift. Private investors now at 4.6% in gold. Small number? In global finance, moving from 1% to 4% means hundreds of billions leaving paper for hard assets. Pension funds, sovereigns, family offices, losing faith in debt, scared of inflation, currency loss, trend unstoppable, dirty secret, JP Morgan knows $8,500 is coming, current $5,200 is joke, so why smash? They're accumulating. Double game. Use paper to crush feeling, make you sell ETF or physical cheap. They scoop it up before run to $8,000. Classic shakeout. Drive below support, trigger stops, flush weak hands, get cheap metal for their long positions. They're not short because gold worthless. Short to buy time. Load boat while keeping price low. If price jumped to match London today, they'd pay more. Suppressed to be buyer of last resort. So $8,500 is their real target. Crash to $5,200 is just a stop to refuel. Get off now, you miss the ride. Look at world prices, not rigged one. $132 China, $118 Mumbai. US $108 is hallucination. Glitches get fixed, usually hard. Final verdict. We walk the crime scene. Victim is US price discovery. Killed by desperate attack to fake reality. World decoupled now. Arbitrage broken. Geography decides wealth. 3 realities. New York, $108 silver, $5,200 gold. Fake. Paper manipulated. Can't get real delivery big. Mirage. World, London, Mumbai, $118 silver, $5,500 gold. Fair value. Real trades between sane people. China, $130 silver, $5,600 gold, hard floor, desperation price, billion people, zero stock, black hole pulling metal west. Tragedy, millions in West see reality 1 and sell, panic. Who buys? Reality 3. Every American selling SLV or bar cheap, Chinese entity grabs discount ounce, ships to Shanghai, not just losing cash, giving generational wealth to East, selling insurance to people betting your house burns for $24 less. This gap, $300 gold, 10 plus in silver, is first crack. LBMA and COMEX losing grip, smash paper, but can't smash physical demand. Keep $108, vaults empty faster. Low prices cure low by killing supply. Cheap in NY means no silver left in NY soon. Final warning, don't let red New York candle shake you from green world reality. Don't be sucker at poker. If JP Morgan says $8,500 gold, why sell $5,200? If China pays $130 silver, why sell $108? Use their trick against them. If banks subsidize by smashing, buy the dip. This sale won't last. Arbitrage bots wake up. Metal runs out. Prices merge. Not at $108. At 132s, then higher. This is John. Game rigged. Spread real. Don't sell to China. Hold the line.